Hi, everyone. I hope this finds everybody doing well. Today, I'm joined by Chief Investment Officer Matt Harbert to talk about the third quarter and the economic overview of what took place. I know, Matt, a lot of our clients love hearing from you. So I'm going to go ahead and turn it over to you to walk through all of the things that took place in the third quarter.
Great. Thank you, Dave. Okay, so for the third quarter, there actually have been several economic challenges. First, the U.S. lost another AAA rating on its debt. Fitch downgraded them from AAA to a AA plus, citing a political standoff, poor fiscal management, and a high level of government debt. That led into another potential government shutdown. They did come up with a temporary solution to keep the government open, although the result of that was the House Speaker was ousted. We saw a spike in oil and gasoline prices where WTI broke above $90 a barrel. Brent crude went over $95 a barrel, and the average gas price briefly topped $4 a gallon. Geopolitically, we still have the war going on in Ukraine, and just after the quarter, there was the terror attack in Israel. So the markets, several of these were reflected in the markets. We actually had a pretty strong first half. So if you look at this chart, you can see the S&P 500 returned about 16.9% over the first half, and the NASDAQ was up over 32%. Although investors became jittery in the third quarter, and it did pull back over the third quarter, where you can see during that time, the S&P 500 was actually down 3.25%, and the NASDAQ was down almost 4%. In addition, the global markets were not immune to these fears either. Over the third quarter, the developed markets were down almost 4%. And the emerging markets were down 2.75%. When looking at the actual individual sectors within the S&P 500, you can see the energy sector actually did really well over the quarter, earning over 12%, which isn't really a surprise given they could take advantage of the spike in oil prices that we saw. Communication services were up about 1%, but all 9 other sectors were down, and some very significantly coming close to a 10% loss for that quarter. Interestingly, the S&P 500 actually performed quite well year to date as of 9/30. However, a small group of stocks, Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla really were the 7 stocks that drove that performance. It's kind of being called the Magnificent Seven. And you can see the performance of the Magnificent Seven on the green line above. For year to date up to 9/30, those 7 stocks performed just a whopping 55%. But when you look at the other 493 stocks in the S&P 500, that's the red line on the bottom, they're exactly 0% over the year, over the 3 quarters. So we did have, even after the pullback in the third quarter, the S&P 500 is up about 11.5%, but it's pretty much all driven by those 7 stocks. So getting on to the macroeconomic side of things, starting with the housing market. The housing market is kind of in the middle of correcting from a bubble that was created back in 2021 and 2022. Back in 2021, we actually had the lowest 30-year mortgage rate that we've had in decades. However, since then, given what the Fed is doing and interest rates overall, those rates have skyrocketed, and at the end of 9/30, they had reached 7.3%. And actually since then, an update as of 10/31, rates actually have gone up even further to 7.8%. The result of this, if you look at the top chart, you can see mortgage rates up at 7.31%. But the charts underneath it, you can see how both mortgage originations as well as refinances really just tumbled since then, where originations reached a high of 1.3 trillion and now have fallen all the way down to 463 billion. And then mortgage originations had gotten as high as 70%, or sorry, refinances had gotten up as high as 70% and are now sitting below 20%. But basically, with prices of housing still elevated, and you can see the mortgage rates skyrocketing, we're seeing a lot of the numbers starting to soften up a little bit. So if you look at the table down below, you've got housing starts, new single family houses sold, and pending houses sold are all down for the quarter. And permits are actually up for the quarter, but looking at this time, they're down 7.25% from this time last year. So overall, a lot of those numbers are starting to soften up. We are seeing that correction occurring in that housing market. Moving on to employment, we're also seeing some normalization in the labor market as well. If you look at the bottom chart here, the labor force participation rate, it's actually been gradually falling since the early 2000s, primarily driven by retirement of the baby boomer generation. But you can see in 2020, it just plummeted due to the pandemic. And we've been trying to recover ever since. And actually, as of 9/30, we're only 0.6 away from where we were pre-pandemic. So we're really close to kind of making up to where we were prior to that time. Looking at the top chart, you can see the purple line is job openings. Employers have been having a tough time really getting those job openings filled. So they've been very, very high. You can see it reached a high of 12 million back in March of 22. But it has since been coming back down and has come down to 9.5 million. Unemployment rate continues to remain low. We did actually get to almost a record low of 3.4%, but it has crept up a little bit. So now we're sitting at about 3.8% on there. So when you kind of combine these numbers along with payroll additions that have also been pretty robust and strong, it really suggests that employees are returning to the workforce, and employees have been successful in filling some of those open positions. When looking at hourly earnings, you can see that hourly earnings have been declining since March of last year as well. However, looking at the bottom chart, which is real average hourly earnings, which are adjusted for inflation, we've actually had 5 consecutive months above that are in positive numbers. Really what that means is those 5 months have had growth in real hourly earnings that have surpassed inflation. And that's actually prior to May, that's kind of turned around a trend that it's been negative for 25 consecutive periods. So we are seeing some positives there as well. Looking at inflation, inflation has been trending down. It's still elevated. The Fed's target is 2%. You can see the top chart shows that the headline rate is sitting at 3.7%, and the core on the bottom chart is at 4.13%. So while the longer term trend has been one of declining, we did actually flatten out in the headline rate, even picked up a little bit over the third quarter. Although the core rate has come down a little bit as well. And really some of the drivers to that, when you look at the headline, the reason why That's picked up a little bit over the third quarter. Again, goes back to the increase in oil prices and gasoline. If you see the top highlighted yellow portion on this table, that's the energy section. For the last several months, energy's actually been helping bring down inflation, but starting in August, you can see that spike going in both gasoline and fuel oil and energy as a whole. So that's really turned from kind of helping bring inflation down to kind of having the opposite effect and driving that up a little bit. On the core area, most of the core commodities are looking very good. They're starting to come back, particularly in the used car and trucks area. But services, core services, continue to be sort of that sticking point. You can see shelter is still very strong. And in fact, in September, each of these areas ticked up a little bit. And that kind of leads to the Fed policy. So now kind of recapping what they've been doing, starting in early 2022, the Fed's been on this drastic tightening schedule to combat what they felt was inflation getting out of control. During that period, they raised rates 525 basis points. But we think that they're actually at the end of their tightening cycle at this point. They've only hiked once over the last 4 meetings, and they've been on pause the last 2. And in addition to that, their comments have really shifted a little bit. Previously, they were extremely hawkish, and they've kind of moved over to just sounding a little bit more cautious with their guidance that they're moving into this data dependency. So going forward, they're really going to be looking at the data to determine how they should adjust rates. But they have made it very clear that they haven't ruled out an additional rate hike before the end of the year if either the economy or inflation just heats up a little too much. So looking forward, really the big question is a recession coming soon? And interestingly, we got the recent GDP reading for the third quarter, which ended up surprisingly strong. Came in at a 4.9%, which was over double what we had in the second quarter at 2.1%. But growth continues to be driven by strong consumer spending. And we've been talking about this for several quarters that, it is surprising given that consumers are facing such high interest rates and high prices, but they keep dipping into kind of the same 2 sources that have allowed them to keep spending. And one of those is excess savings. Consumers built up quite a bit of excess savings while they were quarantined at home. That peaked up at about 2.3 trillion of savings. And we can see since then, they've been chipping away at that. It's now sitting at about 1.1 trillion. So they've spent over half of their excess savings that they had available to them. And that's the Blue Mountain chart that you see on this graph. And the blue line chart, that's kind of the personal savings. So you can see that personal savings rate is actually declining as well. So they're chipping into their personal savings, and the savings rate is actually negative at this time. So that is obviously something that's only really a temporary source until they deplete that. The other thing is they've turned to heavy borrowing as well. And we can look at several metrics to really see this. So you can see the US credit card debt has hit a record high of $1 trillion. And then 3 others. Mortgage debt is sitting at 12 trillion, auto loan debt at 1.5 trillion, and total household debt sitting at over 17 trillion. All of these are records as well. And as far as getting back to GDP a little bit, as far as growth, we do actually see some headwinds to this growth. On the demand side, We do have higher oil prices, and as we've talked about, interest rates are also high as well. So both of those, are headwinds to the consumer. On the supply side, we're having that slowing down of the labor market a little bit. And then housing. We are in that housing correction that's facing the higher mortgage rates and continued high prices as well. Lastly, we can look at some of the traditional predictors out there. One of those is the yield curve. So the yield curve has actually been inverted for quite some time. You have the 10-year to 3-month yield curve, and that's been inverted for 12 months. And then you have the 10-year to 2-year, and that's been inverted for 16 months. And generally, we look at when a yield curve inverts, it typically suggests that a recession could be coming sometime over the next 18 to 24 months. And as you can see, the 10 to 2-year at 16 months, we are creeping up on that pretty soon. And if you look at the bottom chart, this is actually something called the Estrella and Michigan probability chart. So it's essentially using the data of the yield curve, and it is predicting it's giving a probability of a recession a year out from now. And that on June 30th actually hit the highest it's been since the 1980s. It hit 67.3. Although over the third quarter, you can see it's been trending back downwards, where it's at 9:30, it's sitting at 56, basically about 56%. So essentially, this is predicting with 56% probability that sometime in the next year, we could have a recession. Some of the other things that we look at are leading indicators. This table is a heat map of various indicators that are considered leading indicators of the economy. If you read this kind of right to left, you can get a sense of how we're moving kind of out of the green and yellow into more yellow, orange, and red. So that's kind of showing that these indicators are starting to deteriorate a little bit, and they are starting to flash that there could be a recession coming. I'd say overall, these are sort of mixed. The year-over-year retail sales did grow at 3%, so that remains strong and positive. Consumer sentiment did rise by 3.7%, so that improved a little bit. On the negative side, we already talked about the 10 to 2-year Treasury yield curve is heavily inverted. We've got some of the Fed indexes, the Philly Fed manufacturing and the New York Fed current business activity have remained negative. And then lastly, you've got building permits and housing starts, which are green, but you can see that it's gone from heavy green. It's been sort of trending down towards the lighter green as we've been in that sort of correction period. And it's actually fallen for those, each have fallen for the last 4 quarters. So these indicators are really kind of hinting that, we're going to start having some slower growth, maybe even negative growth going forward. Now, while we do see several headwinds to growth, we don't think that there actually is a high probability of a recession this year. I mean, as long as the consumer continues to spend, it should stay positive. However, as we mentioned, some of those areas that they're able to tap into in order to keep spending, at some point, those are going to, they're going to lose access to that, and we should start seeing a reduction in spending. There are also several tailwinds to growth. We are at the end of the Fed tightening cycle, so that should start easing some pressures on consumers and businesses as well. And lastly, as employment is normalizing, it is still solid. So the employment market still is pretty robust. So we do think we're not going to end up in a recession by the end of this year. In 2024, we are seeing, as we mentioned, some of the indicators pointing out that there is a likelihood we could get into a recession at that time. We might put maybe a 50-50 chance of a recession in 2024. However, there will be a recession at some time. So that probability, the longer we go out, gets a little bit higher. So if we don't see a recession by the end of 2024, the probability that we get one in 2025 increases pretty significantly. Other areas, inflation, we continue to believe that the CPI will be around 3 to 3.5% by the end of the year. We actually fell below 3.5% in the second quarter, but as we saw, it's upticked a little bit in the third quarter, given some of the increase in oil prices. But we do believe it's going to remain about 3 to 3.5% by the end of the year. Obviously, if we did manage to get into a recession, that would put additional downward pressure on prices. But as we mentioned, we don't think that's a very high probability. And then what do we think the Fed is going to do? We do think the Fed is at the end of their tightening cycle. It's certainly possible they could raise one more time in December, given the economy, if it ends up being very hot or if inflation continues to tick up. It is possible we could see another hike in December, although at this point, we think the highest probability is that they're probably done for this year. And that is the update for the third quarter.
Matt, a lot of great material in here. And again, thank you for walking all of our clients through this. I know that we get so much great feedback from clients being able to have this data presented to them in this fashion. So thank you very much. And for all of our clients watching this, if you have questions for Matt or for your advisor, feel free to reach out to us. We'd love to have a deeper conversation with you guys. And wishing everybody a great start to the fourth quarter here. And we look forward to talking with you all soon.